Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So we'll dive right in, take a look, see what's going on. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com is where I dive deeper into all of these topics, sectors, areas, looking for potential investment opportunities. Mayday coupon code is still active at this time. Starting with myself, Canadian dollar versus the US dollar looking coiled. We've got the Australian dollar that is broken out against the US dollar. And we've got the Brazilian real putting in a bottoming work against the USD. So here's the Canadian dollar versus the US dollar. It is a ratio. What is important about this is last commodities bull market, we had a breakout from 2001-2, and we broke out in 03, where the Canadian dollar outperformed the United States dollar. It means that the US dollar was weakened. And that weakening is important because all of the commodities that we price our stuff in is against the dollar. The commodity countries like Canada, Australia, etc., their currencies strengthened. And what we saw during that period was money flowed from United States dollar assets into Canadian assets and commodities and other currencies assets where those currencies were strengthening. And we've got the same setup: 1, 2, 3 hump consolidation with a sideways action, 1, 2, 3 with a sideways action, and we're squeezed up right where this was in 2002. I think that's where we're at. And it sure looks like this wants to break to the upside, where the Canadian dollar is going to outperform the United States dollar. What does that mean? It means that the US dollar is about to weaken at some point. And that's what the market is betting on. The market, not me, the market. Then we look at the Canadian dollar, or the Australian dollar versus the US dollar. It's got the same setup. It's the same stinking setup. Big downtrend line. We bottomed in 02. 03, we started breaking out of this big pattern, and we came all the way up. Now we had a three hump consolidation: 1, 2, and then 3. And now we're in that dead period. And now we've just broken out of that dead period to the upside, where the Australian dollar is about to outperform the US dollar. Same thing. And then the Brazilian real, three hump consolidation sideways. We've broken out of that falling wedge, and we've just been moving sideways, basing out for a potential move higher with time. It's in the bottoming process. So again, it's putting in that bottoming work against the USD. It'll eventually work its way on up. And this is the driver of a lot of things like commodity bull markets. It's not the commodity supply-demand imbalance. It is that to some degree on the longer term, but it also is a huge impact with the dollar strength or weakness. That is one of the key factors in everything commodity bull market. Coming down to XOP, has a nice bullish engulfing with an inverse head and shoulders. So here's XOP. We've got a shoulder, a head, and then a shoulder. And I kind of drew that a little bit weird. I think that should be positioned upward a little bit more. But we do have a big bullish engulfing on the right-hand side here on the monthly and weekly candlestick. This is the weekly candlestick, and you can see kind of the downtrend we've gotten, and then the big bullish engulfing candlestick that we got last week, and the downtrend line break. So this is looking better, and hopefully we get some follow through next week for XOP. And we also have XLE, which is another energy fund. It says XLE with the nice bullish engulfing at resistance. This is on the monthly candlesticks, big bullish engulfing on the monthly so far. And yes, we do need to close this month out strong. We're also at that resistance line that we're trying to break through. You zoom into the weekly, nice strong weekly action with a nice big bullish engulfing, breaking through resistance back above. So that's XLE, which is it has more of the larger energy companies in it, like the Chevrons and stuff like that. So this looks really, really good for a potential break higher. It looks like a very good setup. Now, speaking of ExxonMobil smashed through the 2-year resistance at all-time highs last week. If energy keeps surging, look for XOM to lead. One of our leaders, XOM, ExxonMobil, one of the largest companies, is starting to break to the upside. Very similar to XOP, very similar to XLE. And I look at all of these things across the board. Now, there are companies that are not as big as ExxonMobil and not as big as XLE and some of these bigger ETFs. They are way down here. They are we'll call it the high cost producers that haven't really moved yet. That's what I'm interested in. Why? Because that's where you get your 10x moves. It's the ones that are able to grow production rapidly, and they are high cost, which then torques the living crap out of them. Torque means that when the price of oil goes to $100 per barrel, it does not go up 20, 30, 40%. It goes up 2, 3, 4, 5, 6, 7 times. They also pay dividend yields where their dividend yield will fluctuate dramatically. So if we go into a sustained long period of high costs for oil, then we are going to get a lot of dividends. I mean, a lot of dividends. It's going to be one heck of a ride. And again, if you're interested, that's where the website comes in. Mike Sicardi says mortgage rates need to dip under 5.5% to spur big-time buying demand per John Burns. So it says, what's the highest mortgage rate you take on for buying a home? Today's mortgage rate is 6.2%. The magic mortgage rate, according to most of these people, 47% is somewhere between 5.49 and 5%. That's the magic rate. Now, if we get below that, then we get a gaggle of people who want to buy homes in terms of affordability. I'm sure refinancing would explode too of all the people who did buy homes over the past few years, if rates get that low. Sem or Kem says, Exhibit 6040, the lost decades are more common than you think. Most started with high valuations on stocks and or bonds. So this is a 19-year period. So this is, let me read the y-axis. Growth of the dollar in real terms of a 60-40 portfolio in log scale. And this is your time frame going all the way back to 1900. And these lost decades, this is where the 60-40 portfolio did not do well at all. We're talking down 1.8%, 0.2% gain, 0.4% gain, 0.5, 0.7, and minus 1.6. I am also in the camp that this will be a lost decade where commodities run and the 60-40 portfolio does absolutely crappy like these other times and other periods of time. 19 years, 13 years, 7, 9, 11, and 10. I think we're going to get something like a 10 or 11 or 12-year period where we go sideways or we don't really do very much. I think that's coming. Now, last bull markets in commodities, where did they occur in? Right here. It occurred here. So commodity bull market, commodity bull market, commodity bull market. It's almost every single one of these periods was a commodity bull market. And that's where I think we want to be, is in commodities. Now, people are going to say, well, you're a perma bull in commodities. I am a perma bull when I need to be a bull. From 2020 onward, I'm going to be a bull in commodities because it's cheap and equities are expensive. It does not mean that equities cannot go higher. I think that commodities are going to go up more than equities. That's what I think. And I think that these periods are all very similar, and commodities have been favorable and have vastly outperformed in these timeframes. Now, I'm not talking about commodities in general. That's not where I'm putting my money. I am putting my money in commodity equity companies that can go up 10 to 100x. And this is the only time that those commodity companies can return many decades worth of returns in a decade. So when you look at the performance of Peter Lynch, he averaged something like 20-something% per year, 28, 29%, somewhere in there. I think it is possible to beat Peter Lynch's entire investment career in less than a decade. And you can do that in commodities if you buy them super cheap. You buy the particular, high cost producers, and then you ride it for that entire period and then sell out. You can outperform during these periods of the best investors in the world because of the valuation discrepancy. And during these periods, this is where the big growth comes from in those high cost producers, because that's where they can grow production. And with the commodity price at their back, the wind at their back for commodity prices, that's where you get the extreme multiples. AMR, which is a company, it is a metallurgical coal company that did a lot of things right since 2020, has already been a 100-bagger since 2020, which means it basically outperformed every one of those people in this short period of time. And there are other companies that they might be able to do something like that. 50x, 80x, I think they are possible. And there's a lot of companies that did that last bull market from bottom to top. Now, are we going to get bottom to top? Maybe not. Some of these companies are pretty close to their bottom still. I think there's a lot left. Metals, weekly price performance, nickel being the best, tin being the second best, zinc, lithium coming on up. The worst, palladium, platinum, and copper. I would still be looking at palladium and platinum down here, though. Coming down, we've got Peter Lynch. Ultimately, it is not the stock market nor even the companies themselves that determine an investor's fate. It is the investor. Coming down, Trend Spider XLE Energy Sector ETF versus the S&P 500. It is a ratio. All charged up and ready to perform. Here we are, ready to outperform. Why does he say that? Well, I just showed you up here XLE that was basically breaking to the upside of its chart. So that breakout is most likely going to cause an outperformance of XLE versus the SPY, and this is a falling wedge pattern. See how that all kind of plays out? XLE breaking to all-time highs here. The last decade, that also correlates to what I'm talking about here. We're in the lost decade, most likely. Energy is cheap. Energy is cheap against the S&P 500. Falling wedge, ready to break. It all aligns. It's not one piece of data that I look at. It's everything that makes and paints the picture. Here's Charlie Munger. He says, it's extremely good at explaining something in a few words. It's so simple. You spend less than you earn. You invest shrewdly. Avoid toxic people and toxic activities. Try to keep learning all your life and do a lot of deferred gratification. If you do all of those things, you are almost certain to succeed. And if you don't, you're going to need a lot of luck. And you don't want to need a lot of luck. You want to go into a game where you are very likely to win without having any unusual luck. Yeah, I don't usually write sentences like this last one here, but that's Charlie. James says, good afternoon. The U.S. government borrowed $382 billion in the last 5 days. Have a great weekend. That's a lot of money, guys. We're chucking through billions of dollars like it is nothing. XLE divided by TNX, or XLE and TNX, sorry. These charts make you think. These really don't look that bearish when you zoom out. Coming on up, this is the 10-year yield and XLE, the ETF, and look at how correlated they are. Look at how correlated. So if XLE and energy starts to run, what do you think interest rates might do? We'll see. It looks like they're going to run higher. Bullish bets on crude oil are surging. November 100 call options see the highest open interest on record. I thought everyone was bearish. What's going on here? Now everybody's turning bullish on $100 oil call options. Another one from Peter Lynch. He says, big companies don't have big stock moves. In certain markets, they perform well, but you'll get your biggest moves in the smaller companies, says Peter Lynch. Obviously, a smaller company can more easily grow earnings. Brady says, gold resumed its secular bull market in Q4 2023 and silver Q1 2024. So the hardest work is already done. But one has to believe in a bull to really profit from it. And this being the third and final bull move, you will only have one chance, and it is a vital one. There we are with silver breaking out and gold breaking out. You got one chance, guys. Are you going to take advantage of it? JC Parrott says, I'm thinking we're probably not going to see a steepening yield curve. And he's probably, I think he might be being serious. B of A Global Fund Manager Survey expects a steepening yield curve more than any time in history. When I hear this, I think of this quote: if everyone is thinking alike, then somebody isn't thinking. General Patton. And here it is right here, 08, 16, 21, and here we are at 24. Steepening means that it's going to come back down, not go back up. Just an FYI. Silver, Russia. So Russia is boosting its silver reserves. More people buying silver. Here's the 2 and 10 yield curve and unemployment rate. It's been coming on back down. Now, are we going to come back and reverse that steepening? So the steepening is when the curve falls. That's what steepening is called. That generally occurs when the unemployment rate goes up. We've been coming on up here, and it's ticked on down the last tick, but we'll see what occurs. Are we going to actually come back up and invert the curve again? Man, that would be crazy if it did that. It'd be absolutely crazy. This is global liquidity entering the next bullish phase in the long-term cycle. I've showed this before, but what I'm really showing you is, if you look at where these things have come on down here, so we've got a 2020, 2000, 2007, 2019. Look at the global liquidity. 2007 was right here when liquidity was coming on up. So 07 was right here, and liquidity was coming up for a while here. The other one was, we had a decline in 2000. So here's another one in 2000. So liquidity, actually that was a little bit slow there because this is 2001 where the slowdown occurred. Then liquidity came into the market afterwards. Then we had 2020, but liquidity bottomed in 2019 and started coming back up in 2019 and then 2020. So we're coming back up, but I don't think this will prevent a slowdown necessarily. As we saw in 2007, liquidity was coming up in 06, 07. Same with 2013, 14. Same with all these. So just because liquidity is coming up doesn't mean that we don't get a slowdown in the short term. That is still possible. And that's all I'm trying to convey here. And that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. That's all I've got. So we'll catch you next time. This is Finding Value.